William O'Neill and company is joining us right now to take some questions. Dean, great to have you with us here. Thank you very much. Should we see some momentary pullbacks across markets, be it yields, be it equities, be it the dollar, because of maybe just positioning? Otherwise, for a durable kind of turn, do you see any reason as well, or not really?
Yeah, great question. So the setup right now is that U.S. market reacted negatively to Fed's raising rates last week, as well as stronger than expected CPI numbers. So in the market, we've had 6 failed follow-through days, and we're testing June lows. And should we break that level, we're looking at 6 to 7% downside to the next level support. Both indices are 25 to 30% off highs, but in a typical bear market, historically you would suggest that we could see up to 40% or more off highs. So I don't think we're quite done yet. Now, inflation remains a thorny issue for the Fed, and they will likely raise policy rates another 150 basis points or so. And that's according to the dot plan in January, up until January. Now, the flip side of this is if you look at the bond market, how they're forecasting inflation, inflation is estimated to rapidly decline to 2% by the end of next year. And this is according to the forward inflation break-even data. So in the meantime, the U.S. dollar is spiking again due to Fed action last week. And this has had a ripple effect across global markets, with most of the markets in downtrend currently. But I think the silver lining is that, if you look at bond market and how they're forecasting inflation, it's going to come down rapidly next year, which means that, as we've heard Mr. Al-Arian say, the Fed is behind the curve. That certainly seems to be the case, but they are intent on fighting inflation at the moment. And until we see signs that CPI is coming down below expectations, or ironically, we see bad data or bad economic data starting to come out, I think this is when the market's going to bottom. The logic here is that the bad data will prompt the Fed to cease raising rates and become much more dovish. So until that point, I think we're going to continue to see volatility. Now, mind you, the market is a bit oversold right now, and we may see some, a rebound in the market. But we don't think that's going to last. We think definitely we're going to test June lows and potentially break it until, like I said, either the CPI number comes down or we start to see bad economic data.
Dean, hi, good morning. What about India? We have been an outperforming market despite the last couple of days of fall. While the debate in the US is, are we back in the bear market? In India, we're just 7% away from all-time highs. Your thoughts?
Yeah, so definitely India has been a shining star amongst global markets, developed, advanced, all included. Right now, we're at a critical point. The market's testing the 200-day moving average. Should we break that level? I think we're looking at 56,000 for the Sensex, which is at the 100-day moving average. That's about 2% below. And then, if we break that, then we're looking at 55,000. But, when I look at the market, it's fairly resilient. And that's because I think inflation in India is pretty stable at around 6 to 7%. It's been that way for quite a long time. And as well, GDP growth is still, pretty much positive, although India is slowing down a bit into 2023. So what I would say is, keep focus on those names that are working. And now is about the time you may want to start to think about trimming positions on those stocks that are overextended to the upside.
Okay, so 56,000 is the next level to watch on the downside on the Sensex. Although you do believe that the market is very resilient. Got that. Dean, what are your thoughts on which are these stocks that have sort of extended and now perhaps you'd be a bit cautious? Is it in the banking space? Is it in FMCG? Because these are two pockets that have done quite well up until now.
Yeah, I see them, pretty much scattered all over. For example, like Ambuja Cements, they're pretty much extended. CG Power, Tata Investments, Tube Industries, Varun Beverage. These are all names that have done very well, but now we're starting to see some signs that, we may see some profit taking. And so, I would just say keep an eye on those. But definitely they're pretty much far above the 200-day moving average. And those are the candidates that you might want to think about trimming.
Right. Dean, the IT services index, have you looked at it? How are things? I mean, that's the one large grouping in the market which is not seen any bounce, any meaningful bounce, even though broader Nifty, Sensex and other indices have done that. How is that looking, the IT services space?
I think they're still on a downtrend. I haven't taken a close look recently, but, unfortunately, they're kind of grouped into overall tech sector globally. And, they haven't done well so far this year. I think we need to see some signs that the tech sector is going to bottom. And again, that's not until, we see Fed backing off and when we start to see some bad economic data. I think that's when the tech sector is going to bottom.
Okay, so that's on the tech sector. Any other key levels? What are the levels that you're watching out for on the bank Nifty, for example? And, what about key stocks like, say, something like a Reliance that has started to now correct a bit? Any thoughts there?
For the banks, I think we're taking a look at make sure it can find support. Let's say the 50-day moving average. For instance, SBK, State Bank of India. We want to see the stock kind of hold support at the 50-day moving average and kind of bounce from there. Other stocks like ICG, ICICI is pretty much the same setup. But should we lose support at the 50-day moving average, then we're looking at, further downside. So I would be cautious. But, let's see if we can hold that 50-day moving average support. In terms of Reliance, I haven't taken a look recently, but, I think also, could be wary of, the stock, make sure that we can find support at around 2250, that sort of level, and see if we can bounce from there.
All right, we'll leave it at that. Dean, thanks a lot for joining in and giving us your view. So that's the word coming in on the markets and the way forward for equities. He says that's 56,000 on the Sensex, which is the 100-day moving average, is the next level to watch out for on the downside. But the Indian market is fairly resilient and he's not worried about a large shakeout from here on.